Welcome to the Deep Dive. We sift through the sources so you get the essential intelligence fast. Today, we're tearing into the Q3 2025 earnings call for SmartFinancial, that's ticker SMBK. And our mission, really, is to figure out how this regional bank managed, well, one of the most proactive and strategically engineered quarters we've seen lately in the sector.
Yeah, that's absolutely the story here.
Yeah.
Look, if you were listening for a management team that was actually, doing things with this balance sheet, driving future profit, rather than just sort of waiting for the Fed or hoping things get better, well, this call was pretty fascinating.
Right.
The quarter was really defined by these highly coordinated strategic moves, all designed to accelerate capital growth, boost margins structurally. And they did this even with the whole regional bank environment still being, pretty challenging.
Okay, let's jump straight to those headline numbers then, because they really delivered a very clean beat. Non-GAAP operating EPS, it came in at 0.9 and 86 cents, which was, that was seriously impressive. It crushed the consensus estimate of 0 and 73 cents. That's like a 17.8% beat.
It was a huge beat on the bottom line, absolutely. Revenue was maybe less dramatic, hitting $51.07 million.
Yeah.
So it just narrowly beat consensus there. But looking at the bigger picture, they delivered 15.6% year-over-year total revenue growth.
Right.
And that kind of organic expansion, well, that's a real achievement in this kind of market.
And the market seemed to agree. Shares moved up almost 3% on the day. That suggests some real confidence in the results, right?
Yeah.
Especially the quality of those earnings.
Exactly. And if you listen to how management pitched the quarter, they kept coming back to their main measure of success: capital execution. Tangible book value per share, TVVPS, hit $26.
$26.
Yeah, and that represents an annualized quarter-over-quarter growth rate over 26%.
Wow.
That kind of TBVPS growth, that's probably the strongest signal you can get about a bank's ability to really compound value over time.
Okay, so here's where it gets really interesting for you listening, because that impressive TBVPS growth, it didn't just happen by accident, did it? Management pulled off, 3 big, highly coordinated kind of capital-light moves this quarter, moves that really set them up for 2026.
Yeah, this was some multi-dimensional chess, you could say. Execution on several fronts at once. So the first big strategic action, selling their SBK Insurance operations. That generated a nice, clean $4.0 million pre-tax gain.
Yeah.
Now, they did keep a little finger in the pie, retained an investment partnership, but they basically monetized the bulk of that business.
Okay, now hang on a second. Selling an insurance arm, yeah, it gives you that immediate cash gain, but doesn't that also mean sacrificing, a pretty valuable, stable source of fee income, maybe cross-selling potential down the road? Was this just like a quick grab for cash, or was it genuinely smart long-term optimization?
That is absolutely the critical question. And management's argument was essentially that the immediate tactical benefit here really outweighed that longer-term potential cost. Why? Because they immediately leveraged that $4.0 million gain to perfectly offset a $3.9 million pre-tax loss they took from repositioning about $85 million of their available-for-sale securities, the AFS portfolio.
Oh.
So they effectively self-funded the balance sheet cleanup, took the hit on the securities, but paid for it with the insurance sale gain. Very tidy.
That AFS trade, that feels like maybe the most impactful move this quarter then, structurally speaking. Can you unpack the implications of that swap for us?
Yeah, it's really all about reducing risk and setting up future structural profitability. So the old securities they sold off, that was legacy low-rate stuff, yielding a pretty measly 1.4%.
Wow, yeah.
They took those proceeds, reinvested them immediately into new securities yielding 4.95%.
Big difference.
Huge difference. That swap alone generates an extra $2.6 million in annual interest income going forward. And it dramatically boosts the overall yield on that securities portfolio up to 3.70%.
Yeah.
So yeah, it wasn't just about boosting income today. It was about cleansing the balance sheet of that low-rate paper and locking in higher revenue for years to come.
Okay, so they defended the balance sheet, boosted future in NIM potential. But what about funding all that growth? They had pretty strong loan growth. That brings us to the third big action, issuing $100 million in new subordinated notes, 7.25% due 2035.
Right. And this is where the strategy gets, kind of sophisticated. They use some of that capital infusion, about $40 million, to retire some existing older sub-debt Okay, standard stuff. But the really key connection point was regulatory. Management downstreamed $45 million of those new sub-debt proceeds directly to the bank subsidiary itself as equity capital.
Okay, so pushing capital down to the bank level, what's the ultimate regulatory benefit of doing that? Why inject that equity?
It directly addressed a major regulatory headache, or at least a focus area, their commercial real estate concentration. The CR ratio. That ratio dropped from a pretty high 301% down to a much healthier 271%.
Okay, that's a significant drop.
It is. And improving that qualitative risk factor, that gives you huge regulatory breathing room.
It's always amazing how much the regulators and the rating agencies focus on that one concentration number. But okay, reducing that perceived risk seems like it created a massive lever on the P&L too, right? Because didn't that improvement somehow offset the provision expense they needed for their pretty robust loan growth?
Exactly right. That improvement in the qualitative factors, specifically the lower CR ratio, allowed them to decrease the total provision expense for the quarter, down to only $227,000.
Wow.
Which is, I mean, it's basically negligible considering how fast they were growing loans. That efficiency gain was absolutely critical in driving that big EPS beat you mentioned earlier.
Okay, so despite all that really impressive structural work, we do still have to talk about the pressure points. Net interest margin, NIM, it's still the Achilles heel for basically the entire sector. And their Q3 NIM did decline slightly, down 4 basis points to 3.25%. What was the specific reason they gave? That timing issue.
Yeah, management explained it was mostly temporary. It stemmed from the timing difference between issuing the new higher-cost sub-debt early in the quarter and then only retiring the existing lower-cost debt later in the quarter. So you had a period with both on the books. And of course, they also faced the general headwinds from higher deposit rates across the market, just like everyone else. But that's precisely why their forward guidance on NIM is probably the most important piece of this whole call.
Okay, right. Let's pivot to that growth and guidance then. Because underneath all the financial engineering, the core business clearly has some serious organic momentum. It absolutely does. I mean, look at the numbers. They reported 10% annualized quarter-over-quarter loan growth, strong, and maybe even more impressively, annualized deposit growth was 15%. That's a $179 million increase in deposits. And get this, they did that while actively reducing their reliance on higher-cost brokered CDs.
That's key.
Very key. Their loan-to-deposit ratio, the LD ratio, it remains really flexible at 84%. That gives them lots of room. And credit quality, it looks exceptionally clean still. Non-performing assets to total assets, NPAs were super low at just 0.22%.
Okay, so this stellar operational execution, it clearly gave management the confidence to make some, frankly, extremely aggressive forward-looking statements on the call. They made a point of highlighting this was their 6th consecutive quarter of positive operating leverage. And they also noted they hit their $50 million quarterly revenue target ahead of schedule. They seemed pretty proud of that. They did. And they project Q4 NIM to bounce back into the 3.3% to 3.35% range, which is, solid. But the number that you really need to circle and pay attention to is this. Management is projecting a substantial 5 to 7 basis points of NIM expansion per quarter throughout the entire year of 2026.
Per quarter, throughout 2026.
A quarter. For the whole year, I mean, given all the macro uncertainty out there, that projection is incredibly bullish. It suggests they see continuous structural improvement and some serious margin tailwinds coming their way very soon.
5 to 7 basis points of expansion per quarter. That is aggressive. That's basically guaranteeing they'll outperform peers on margin.
Okay, so how are they planning to control costs while scaling up to meet this growth? What about the expense side? Yeah, they're laser focused on efficiency. Q4 non-interest expense, they guided that to between $32.5 million and $33 million. And that guidance sustains the improvement they showed in the efficiency ratio, which dropped from 66% in Q2 down to 64% in Q3. So they're holding the line there. And their technology investment strategy seems key here. They talked about focusing on AI, bots, digital enhancements. But the goal isn't necessarily about cutting existing staff right now. It's more about preventing the need to add lots of new staff as the company scales its revenue base. That's the engine, they argue, that will sustain that positive operating leverage deep into 2026. Keep revenue growing faster than expenses.
That structural approach, using tech to manage operating leverage as you grow, that sounds incredibly smart for a bank trying to scale quickly. Now, let's just quickly place SMBK's results in the broader investor context, because the regional bank sector, if you track the KRE ETF, it's lagged quite a bit, down over 5% in the month before this call, mostly on funding cost worries and macro jitters.
Exactly. And that's why you see this kind of divergence playing out. The stock popped nearly 3% right after the call. showing the market liked the execution. Yet, you still see some cautious third-party sentiment out there.
Yeah.
Like you mentioned the Zacks #4sell rank earlier. That highlights some lingering skepticism.
Yeah.
It feels like the market hasn't fully bought into that really aggressive 5-7 basis points per quarter margin guidance yet. They want to see it happen first.
Right. So if we're watching the story unfold, what are the key catalysts? What do we need to see actually happen for the market to fully price in this this more bullish narrative?
Yeah, I think it boils down to basically 3 points of execution that you need to watch. First, obviously, the actual realization of that ambitious 5-7 basis points of quarterly NIM expansion to materialize.
Second, the trajectory of their funding costs, especially since they mentioned, 45% of their deposit base is variable cost indexed to future Fed actions. So where do those costs go? And then finally, can they keep up the momentum in talent acquisition? They're growing in attractive Southeast markets, Alabama, the Florida Panhandle. They need good people to keep supporting that target of, say, 10% loan growth.
Got it. Execution on NIM, funding costs, and talent for growth. Makes sense. Okay, we've covered the numbers, the strategy, the context. Now it's time for our segment where we try to synthesize all this data into a plausible, maybe high conviction, if potentially outrageous trade idea. This is not financial advice segment. What have you got? Okay, so look, the core insight here, if you believe in management's track record of execution, which has been pretty good, is that the guidance for sustained 5-7 basis points of quarterly NIM expansion all through 2026. That's structurally transformative if they hit it. It basically guarantees sustained, well above average core profitability. And it seems like the cautious street just isn't pricing that in yet. Not fully. Sure, the market gave them credit for the nice Q3 EPS beat, maybe a bit for Q4 guidance, but not for that whole multi-quarter margin leverage story. Not yet.
Okay, so the market is maybe still showing a bit of show me first attitude on that 2026 guidance. So what's the trade based on that potential compounding opportunity?
Well, the trade idea would be to go long SMBK, but specifically using long-dated call options. You'd be thinking like 12-month or maybe even 18-month duration calls.
Longer-term options, okay.
Why options? Because the thesis is really about capturing leverage on the eventual realization. The idea is that if they continuously execute on that, say 10% loan growth, and they successfully achieve that guided NIM expansion quarter after quarter, eventually the institutional analysts, the street, they'll be forced to revise their forward estimates much, much higher. And that should lead to a significant multiple re-rating for the stock and potentially a stock price surge well beyond that initial kind of muted 3% enthusiasm we saw post-earnings. So it's basically a pure bet on that compounding effect of the margin trajectory playing out over time, using the options to potentially capture some explosive upside when or if the street finally catches up and revises those forward numbers.
Right. A leveraged bet on execution meeting guidance and forcing estimate revisions higher down the line. Interesting. Okay, so just to recap for you. SmartFinancial delivered a clean EPS beat this quarter. They engineered some pretty complex balance sheet moves, especially that AFS trade offset by the insurance gain, all designed to boost future structural profitability. And crucially, they guided for substantial NII expansion next year while still maintaining really stellar organic growth momentum right now.
Yep. And maybe for your final provocative thought to chew on, given this company's proven ability now to execute these fairly difficult capital actions, and their clear commitment to continuous positive operating leverage. The real core question you need to analyze for yourself is this. Can their Southeast expansion strategy continue to deliver the necessary high-quality revenue growth, enough growth to outpace their investments and finally silence that remaining external skepticism we talked about? We'd really encourage you to dig into their deposit beta projections, how sensitive their deposit costs are to rates, and weigh those against your own view of the evolving macroeconomic outlook. That might hold the key.
Excellent point to consider. That's it for this deep dive. We'll talk to you next time.